Hello, everyone, and welcome to our latest webinar session. This one is called How to Create a Tax-Efficient Retirement. My name is Tom Bittinger, and I'm with the marketing team here at Wealth Enhancement. And before we get into it, I want to go over a few quick housekeeping items. There will be a Q&A session at the end of this presentation, so feel free to submit questions using the questions pane on the side of your GoToWebinar menu, and we'll get to as many of those as we can. Anything we don't get to, we will make sure to have somebody reach out to you with an answer to your question. And as always, we are recording today's session. So if you need to step out for anything, if you missed something, no worries. We'll send out the recording to you as soon as possible so you can revisit that. And then also share it out to anyone you feel like might get any use out of this information. So I would like to introduce today's speaker. He is Bruce Helmer. He's a co-founder of Wealth Enhancement, as well as being a financial advisor. He's the host of the Your Money radio show and has been since 1997. He's the author of 3 books on finance. He is a professional speaker. The multifaceted Bruce Helmer, thank you for joining us. I know we have a lot to get into, so I would like to hand it off to you.
Thank you, Tom. Thanks for joining us, everyone. We appreciate it. I have it in my contract that all marketing events, they have to use my high school graduation picture, so I don't look like that picture anymore. Unfortunately, I look like the person you see in front of you today. As Tom mentioned, we're going to talk about tax diversification. Before we jump into that, at Wealth Enhancement, everything we do starts with core values. What's important to you? When do you want to retire? What does your retirement look like? Are you going to help your children? Are you going to help your grandchildren? Are you going to volunteer? Are you going to travel? What does your life look like? And a lot of presentations I do, we spend a lot more time on this. We can have several slides on this, but today I just want to emphasize that everything starts with core values. What's important to you? And the advice that we give is going to be very specific to your situation. It's not generic advice. And in terms of investment management, which is part of comprehensive financial planning, part of what we do at Wealth Enhancement, we're not trying to get the highest rate of return that we possibly can for you. We're trying to get the rate of return that you need to reach your goals and objectives based on your core values. We want you to get what you want when you want it, and we want to get that with the least amount of investment risk possible. And a part of that is going to be what we call tax diversification. Many of you probably understand diversification in terms of assets, asset allocation, diversification into a lot of different asset classes. You might have stocks and bonds and real estate and cash and precious metals and so forth. But many people that are good at diversification from an asset class standpoint don't understand tax diversification, and that's really going to be our point of emphasis today. Investments can only be treated one of 3 ways from a tax standpoint. They're either fully and immediately taxable, meaning you get a 1099 on your gains or on your interest or on your dividends, or they're tax deferred. The taxes are delayed until some point in the future, and this is something that most of you are probably very familiar with. You might have a traditional 401k or some other type of retirement plan on your job. You might have an individual retirement account and so forth. So taxable, tax deferred, and then finally some investments might be tax advantaged or completely tax free. Probably the best example here is Roth IRA. Now, it may sound oversimplistic, but if you can avoid taxes altogether, that's better than just deferring or just delaying the tax. But if you can delay the tax, it could be argued that that's better than having to pay the tax right away. All things being equal, avoiding the tax is better than just delaying the tax, but delaying the tax is better than paying it right away. The thing is, all things are not equal. So with taxable investments, and many people try to actually avoid having taxable investments, and the reason why is because I don't want to have to pay taxes on my investment. Whatever my gross return on investment is going to be, it's going to net down by the amount of taxes that I have to pay. So I don't want to have to pay taxes. Consequently, a lot of people that I see for the very first time have very little money in taxable accounts. And I would tell you, I think that's a mistake. As a financial advisor, but also as an investor myself, I have considerable assets in taxable accounts. Now, let me talk about some of the advantages. Everyone understands the disadvantages paying the tax, and you don't want to pay the tax. But these accounts are liquid. To get tax deferral or to avoid the tax completely, you probably have to give up some liquidity to get those tax advantages. On taxable accounts, the money's accessible, and there's something to be said for that. Think about your kids in their 20s or 30s or even 40s. How often do they need money to buy a house, to improve their house, to pay for a wedding, to go on vacation? And money in retirement plans that are tax deferred or tax advantaged don't have that kind of accessibility. So taxable accounts are generally liquid. Taxable accounts generally give me the opportunity to get a lower tax rate on the gains, something called long-term capital gains, as opposed to ordinary income tax. And then finally, probably the biggest one is taxable accounts allow for something called a step up in basis. What that means is, let's say I go out and I buy a stock and I pay $1 a share for the stock. And over time, the price of that stock appreciates to $100. If I go out and sell that stock, I've got to pay capital gains taxes on that $99 a share gain. But if I never need that money and I never sell that stock, but I leave it to my children and they inherit that stock, their basis steps up to the value of the stock on the day I die. So if they inherit that stock at $100 a share and they sell it at $100, they don't pay any of that tax for all those years of gain on that stock. You can't get a step up in basis on tax deferred accounts and tax advantaged accounts. So there's a lot of advantages to having money in taxable accounts. Now, tax deferred is where most people have most of their money. And that's logical. I understand that. Most people participate in their company retirement plan, their 401k or whatever the plan is. And if it's a traditional plan, you're putting money in. Now, some of the advantages and the reasons these plans are so popular is you get a deduction for the contribution the year that you make the contribution. So it lowers your taxable income in that tax year. You don't get any 1099s on the gains along the way, so it just grows without you paying taxes. And then, and ultimately, you pay the taxes when you spend that money. Now, there can be even additional advantages if it's something like a company 401k. Your employer may even make a matching contribution on it and give you extra money for your contribution. So when I see people for the first time, the vast majority of their net worth is in tax deferred accounts. And I'm not here to tell you that they're bad or that you shouldn't do tax deferred accounts, but I am here to tell you that they are not the only thing that you should do, or they should not be 60, 70, 80, 90% of your money. We want more diversification into some of the other ways that investments can be treated from a tax standpoint. Now, as many of you may or may not know, these tax deferred accounts, generally speaking, whether you want to spend the money or not, Uncle Sam's going to insist that you do when you get to be 73 years old. It's called required minimum distribution, and we'll talk more about that in a bit. Additionally, you can't really get at the money. There's some exceptions to that, but generally speaking, you can't get at your money until you're 59 and a half years old, or if you take it out early, you might be looking not only at ordinary income taxes, but there may even be a 10% penalty. And finally, the tax never goes away. So when you invest in these tax deferred plans, when you spend the money, then you're going to pay the tax. But if you never spend that money and you leave it to the next generation, guess what? They're going to pay the tax. Uncle Sam basically says, we're going to cut you a deal here, and we're going to let you put money into a plan, and we're going to let you get a deduction for the contribution, and we're not going to make you take money out, and we're not going to tax you along the way. But at a certain point, if you don't start to spend it on your own, we're going to insist that you do so we can get our taxes. And if you die and don't spend it, then we're going to tax whoever gets the money. So again, not a bad investment, but you need to be aware that that tax lien is there forever. And then finally, tax-free or tax-advantaged accounts. And again, there's a couple different possibilities here, but probably the most prevalent and probably the most efficient is Roth IRA. Now, in a Roth, you don't get a deduction for the contribution like you would on a traditional IRA, but as long as you let the money stay there for at least 5 years or until age 59 and a half, whichever is longer, you don't pay any taxes on the gain. There's no required minimum distribution at age 73. So again, avoiding the taxes, I can make the argument that avoiding is better than just delaying. All things being equal, but all things aren't equal, because on the Roth or on these tax advantaged investments, you don't get a deduction for the contribution. So if you were going to compare traditional IRA or traditional 401k to a Roth IRA or Roth 401k, in the short term, the traditional is going to look better because you get a deduction for the contribution, which you don't get on the Roth. But over years and years of accumulation, and then when you spend the money on the tax deferred account, you pay the tax at the back end, and on the Roth you don't. I'm not going to argue which is better. But I am going to argue that I want you to have all three types of tax treatment. I want you to have tax advantage money, I want you to have tax deferred money, and I want you to have taxable money. Now, so far we're talking about saving and investing while we're still working. Let's talk about when we switch from saving to spending, or in other words, we're going to retire now. Now, wealth enhancement, I'm very proud of this, part of our comprehensive financial planning includes retirement income planning. There are a lot of people in our space that can help you invest your money, that can help you get a good return on investment, and they're glad to do that for you. And I'm not going to mention the names, but you know them. There's a lot of people out there that'll help you invest your money. Most of those firms won't help you spend your money. In fact, they'd rather you didn't spend your money because they make more money if you leave it with them and they charge fees on a bigger number. But at Wealth Enhancement, we understand that the reason you save and invest, the reason we helped you try to get a return on your investment so that you can retire someday and you can replace your paycheck with your investments and have enough income for no matter how long you might live and to not run out of money before you run out of breath. We know you're going to spend your money, and we will help you spend it and make sure you're efficient and that you're doing what we call spending the smart money first. I'll talk more about that in a little bit. So while you're working, your paycheck is your paycheck, and there's not a lot you can do about that. It's going to be taxed as ordinary income. But when you're retired, there might be a lot of different sources of income, and none of them are a paycheck. Most of you are probably going to receive Social Security. Some of you might receive a traditional pension. You might have investments that are in taxable accounts that trigger capital gains taxes, or there may be dividends and interest. So there's a lot of different sources of income, and they're not all taxed the same. And a lot of people are surprised to learn until they get to the age of retirement and they're actually going to draw Social Security that you pay taxes when you draw your Social Security benefit. At the federal level, for sure, and depending upon the state you live in, there may also be state income taxes on your Social Security benefit. So in my experience, and I've alluded to this a couple times already, most people, when I first see them, do not have tax diversification. The vast majority of their investments are in these so-called tax deferred plans, where now you're going to pay the taxes when you spend the money, and that tax burden follows you to the grave and it goes on to the next generation. And again, I'm not saying these plans aren't good. There's a lot of good things about them. You got a deduction for the contribution. Maybe you got a matching amount of money from your employer. You didn't have to pay taxes for all those years. There's a lot of things to like about these plans. But if all of your money, or the vast majority of your money, is in tax deferred plans, you've got a problem when you get to retirement, and it really makes it hard for us to have efficient retirement income planning. So I keep talking about tax diversification. Why does it even matter? So here's why it matters. And I had a couple different situations almost exactly like this within the last few months. Somebody's sitting in my office for an introductory meeting. We get acquainted, we talk, we chat, we start to build a relationship, and then we start to look at information. And they pull out their 401k statement, and let's say they got $1 million in there. And I can tell by the way they're talking and the things they're saying that they're proud of that, and they should be. That's a lot of money. They did it. They were a good saver, good investor. They participated in their company plan, and now they're ready to retire, and they've got $1 million. But the problem is, they really don't have $1 million. They talk like they have $1 million. They treat it like it's $1 million. But as I mentioned, there's a tax lien on all this money. When you spend it, you pay the tax. So $1 million is really 700, 750, 800,000, depending upon how you take it out, when you take it out, and what you pay in taxes. But it's going to net down by the amount of taxes that you pay. I had a situation within the last year where somebody had a plan like this with about $1 million, and they proceeded to tell me, now that I'm retiring, my retirement gift to myself is I'm going to go out and get a new car. And it's a $60,000 car, and I'm going to pay cash for it. And they were so proud of that. They were so excited. I'm not gonna finance it through the dealership. I'm not gonna finance it through a bank. I'm gonna go pay cash for my car. Well, the problem is if all their money is in a tax deferred plan, and it was their 401k, to net $60,000 after tax, they probably have to take a distribution or a withdrawal of over $80,000. They're paying $20,000 of taxes to go pay cash for their car. Frankly, I've had situations where I've shown the client, you're better off financing. You're better off paying interest rather than paying all that money in income taxes. Now, wouldn't it be great if I had $60,000 in a Roth IRA or some type of an account where I don't have a tax liability to take that withdrawal, or even on a taxable account? As many of you probably know, the earnings I get on a taxable account, whether it's interest or dividends or whatever it is, I get a 1099. I have to pay taxes on those gains whether I spend the money or not. So if I spend some of that money, it really doesn't increase my tax liability. But on tax deferred plans, everything that comes out of there, you're going to pay ordinary income taxes on. And again, I'm not saying these plans are bad. I'm saying they're bad if it's the only thing you got or the vast majority of your money is in these plans. Now, the best way to create these tax deferred, or to get this tax diversification, and I started the presentation talking about this, is to do it while you're saving and investing and you're still working. I try to coach people all the time. Let's make sure that when we're investing, we're not just putting money into tax deferred plans, but that we're also using tax advantage plans and taxable plans, and I coach them up on doing that. And I'll show you a really good example here at the end of the tool that we use. So smart saving strategies is the best way to do this. But if you're already retired, don't think, oh, well, it's too late for me. Even in early retirement, there might be things that we can do from a strategic standpoint. Roth conversions is a good example. We'll talk more about that in a second. But there might be planning opportunities to create some of that tax diversification, even if you're already retired. In short, it might not ever be too late. Earlier is better than later, but hopefully even in retirement, we can still do some things. So on these tax deferred plans, one of the other things you need to be aware of, and I referenced this a little bit earlier, is they're always going to be subjected to something called required minimum distribution, RMDs. In other words, you get to a certain age, and whether you want to spend the money or not, Uncle Sam is going to insist that you do. And for most people under current tax law, that's now 73 years old. So which plans are subjected to this required minimum distribution? Traditional IRAs, traditional 401ks, most company retirement plans. You get to be 73 years old, and Uncle Sam says, we want you to start spending that money so we can get the taxes that we've been waiting for all these years. This graph is showing the approximate amount of money that you would have to take out. It's a percentage. At 73, it's about 4% of the total, but it's an actuarial science calculation. So the older you get, the higher the percentage is. Now, if you're investing smart and you're investing wisely, that account balance also might keep growing. So not as you get older, by law, you're forced to spend more and more money because number one, the percentage goes up as you get older, but number two, that account balance may be growing faster than you're spending it, and if you're investing wisely and the rate of return is good, it keeps on growing. So it's a bigger number, it's a higher percentage, it's a bigger number, it's a higher percentage, and the older you get, the more that you have to take out of this plan. Now, that's again not necessarily a bad thing, especially if it's growing, because we don't want you to run out of money before you run out of breath. Now, most people think that spending as you retire and as you get older, you spend less and less and less, like the graph you're looking at on the left. But I've been doing this for over 40 years, and I can tell you that's not how people spend. Most people will actually spend much more the first 5, 6, 7 years after they retire than the last few years while they were working. Now, that may seem counterintuitive to you, but think about it. Do you have bucket list or live it list things that you want to do? Do you want to travel? Do you want to climb a mountain? Do you want to go to the Holy Land? Are there things that you want to do? Most people would say yes. So you go do those things early when you're retired, and then at some point you start to slow down. You don't have as much energy. Plus, maybe you've checked everything off your bucket list, and then for a number of years we see spending go down, and then maybe it spikes again later in life for healthcare things. I got to go get that hip replacement. I got to go get my knee replacement, whatever. So it really looks, the way retirement spending looks is like the graph on the right. Now, I didn't get lost. I didn't distract myself by putting this slide here, because I know you're saying, wait a minute, he was just talking about required minimum distribution. What does this have to do with required minimum distribution? I wanted to show you how I know people actually spend money, and I wanted to take that graph of how people actually spend and superimpose that with the graph that we looked at with regard to required minimum distribution. And you can see as you get older and you have to spend more money, you're spending more and more money. And what I want to do for clients is to get those two lines to narrow, get closer to each other, or shrink that gray area. It makes absolutely no sense that these tax deferred plans, we're forced to spend the most, take the most out of them when we least want the money. We're not going to spend as much in our 70s and 80s as we are in our 60s. So how do we plan for these required minimum distributions? And again, one of the things that we do is to try to create this tax diversification where we've got multiple places where we have money, where we can take withdrawals and spend what we call the smartest money first. So one of the things we look at is Roth conversion. Roth conversion is basically you taking money out of a traditional IRA or traditional 401k, a tax deferred plan, and you move it into a tax advantage plan where no future taxes will be due and there's no required minimum distribution. Now, there is a cost to do it. When you do the conversion, you have to pay the tax. But by doing that, now you have less money in the traditional IRA, less money that's going to be subjected to RMDs, and maybe more money where maybe if you want to go get that $60,000 car, you actually have $60,000 in a Roth that you can pay cash for your car and not have to pay $20,000 in income taxes at the time you buy that car. There's certain times where Roth will definitely make more sense than other times, but one of the best times, if there's a sweet spot or a perfect time for a Roth, it's early in retirement, maybe when you're no longer earning a paycheck, but you're also maybe not drawing Social Security yet either, and your taxable income is lower, so the cost of doing the conversion is going to be lower to shift from traditional IRA to Roth IRA. Now, one quick thing before I talk about the 4% rule, I wanted to give an example. Last year, I had a lady come into my office. She was in her late 70s. She had about $5.7 million in an IRA, and she actually retired from the financial services industry. And you might be thinking what I was thinking at the time. You were in the financial services industry. You got over $5.5 million. What do you need me for? What can I do? And you know what her thing was almost all of her money, other than a little bit of put and take money in a checking account, almost all of her net worth was in a tax deferred traditional IRA. And she said, Bruce, I'm getting killed. The required minimum distribution alone, which is more than what I need for lifestyle, is throwing me into a 32% federal tax bracket. What can I do? And I'm like, well, frankly, at this point, probably nothing. But if you'd have talked to me 20 years ago, heck, even 10 years ago, there's probably a lot of things that we could have done to create tax diversification so you wouldn't be stuck with this problem. So that's why tax diversification is so very important. And again, I'm going to elaborate on that a little bit more here before we're done. So the 4% withdrawal rule, many of you have perhaps heard of this before. In the financial services industry, as advisors, they teach us that the safe withdrawal rate at which a client can withdraw money out of their account and not run out of money before they run out of breath is only 4%. Now you might say, does that mean the return on investment is only going to be 4%? Not necessarily, but there's different sequence of returns, right? Everybody probably remembers 2008 when the stock market fell about 50% in 1 year. Well, what if you retired in 2008 and not only did you see your account balance get cut in half because of market retraction, but now you're also going to spend a bunch of money to replace your paycheck? You may never dig yourself out of that hole. So a lot of really, really smart people ran, thousands of Monte Carlo simulations to look at varying sequence of return to see what the safe withdrawal rate is, and they came up with 4%. Now, I got to tell you, I've never bought into this concept. I don't think at Wealth Enhancement we buy into this concept. I think it's wrong, and there's a lot of reasons why it's wrong, but the single biggest thing is probably this, they assume that when you spend money, that you're going to spend it directly proportionate to how you've invested money. That was a convoluted sentence. What does that mean? Let's say you got $1 million and half of it's in the stock market. So 500,000 is in the stock market and half of it is in non-stock, fixed interest investment, bonds, cash, other things with less risk or no risk of principal. And let's say you're going to follow the 4% rule and spend $40,000. Well, the Monte Carlo simulations and all the super intelligent people that did this analysis, wrote these algorithms, did all this work, put in all this time, they assume that you're going to spend 20,000 out of stock and 20,000 out of the fixed income, half and half, 50% is the stock, 50% is not. And I would tell you, if you're my client, I'm going to say, why would you sell stocks when the market's down 50%? Why don't we use your cash? Why don't we use your bonds? Why don't we use something other than stock and take the entire 40,000 out of that and leave your stocks alone until the market recovers, which it did. Even in 2008, the Dow was at 14,000. It went to 6,500 and change by the spring of 09. Today, the Dow is pushing 50,000. If you stayed in the market, you did fine if you didn't panic in 2008. Now, I snuck back into the investment side of diversification again, but also from a tax standpoint. Let's go back to the guy that wants a $60,000 vehicle. Maybe to pay for that vehicle, maybe the first 30,000 can come out of a traditional IRA. Maybe we soak up the tax bracket that this person's going to be in anyway, whether they take an IRA withdrawal or not. And to soak up that bracket, that's 30,000. Maybe they can take 30,000 out at a 12% federal tax bracket, but if they take out any more than that, they kick into a 22% bracket. So we might say, let's take the first 30 out of the tax deferred account, and let's take the second 30 either out of tax advantage like Roth and or taxable or combination of the both. That's the most efficient way to take this withdrawal to buy this vehicle. We're going to spend the smart money first. I always have to do air quotes when I say smart money. Sorry, I can't help myself. So we call this the wealth enhancement smart money strategy. But now if I don't have tax diversification, if all my money or almost all of my money is in a tax deferred account, this option, this flexibility of efficient spending isn't even available to me. This is why it's so crucial to have tax diversification. The lady I referenced earlier was in my industry for years. She retired from my industry. Obviously, she was good at investing. She had over $5.5 million. She had a lot of money. She is a smart lady, but she didn't understand tax diversification. I can tell you right now, as I sit here today, a lot of do-it-yourselfers that maybe are good at investing their money are not necessarily good at creating diversification from a tax standpoint. And even a lot of people in my space, in my industry, don't understand this concept. And it's hugely important to your future success. And it's hugely important to efficient retirement income planning. Now, almost every presentation I ever do has this tool demonstrated. We call this the Your Money Matrix. So when you're working with us, we take your assets and we plot them on the money matrix, and we look at everything and we define, is this taxable, tax deferred, or tax advantaged? And then we also quantify, is this money that you're going to need soon in the next year or 2 or 3? We call that short-term money. Is this money you're not going to use for maybe 7 to 10 years? Or is this money that you know you're not going to touch for 20? Short-term, mid-term, and long-term. And we plot everything on the money matrix, and it tells us where we need to add things, or maybe where we have too much, and how we can make changes and alterations to get both diversification from an asset allocation or an asset standpoint, but also from a tax standpoint. And again, it's never too late, but the sooner we get a chance to work with you, the more efficient we can be. And this is, again, I cannot overemphasize how hugely important this is. And most people in my industry and most people that aren't at Wealth Enhancement aren't doing this kind of planning. And I'm telling you, you're missing the boat if you're not. So that's where we come in. Here's the ask. So again, the reason I do this, I do a lot of speaking events, and as Tom told you, I write books, I do all kinds of stuff. I don't do any of that for any self-promotion reason. Honestly, I know it sounds kind of phony, but I do it because I enjoy it. I do it because I like to help people. And if I can say something, do a presentation, write a book, a radio show, if I can do something that helps people, that makes me happy. But the way we can help people the most is if they actually work with us. And so this is an invitation to come in and see Wealth Enhancement. There's no cost, there's no obligation. The initial meeting, you get to come in, you can ask questions. It's building a relationship, it's having a conversation. You don't have to come in and throw all your personal stuff down on the table. You ask questions, you make sure you're comfortable. If you're comfortable, then you can disclose data. But, you know, again, I'm an investor myself. I'm not only a financial advisor, I'm an investor, I'm a business guy. I look at a lot of deals. What we're offering here to come and see us, there's no cost, there's no obligation. There's no downside. I got to tell you, in my world, you don't see investments very often or opportunities very often with no downside. This has no downside. I always say to my marketing team, I don't know why 100% of the people listening wouldn't do this. Now, I know in reality you don't, but I wish you did, because there's no downside. I'm asking you to come and see us. I see this as a sequence of decisions. You made the decision to tune into the webinar today, and I'm grateful. This wouldn't be any fun for me if I thought nobody was listening to it. I like to do it because people are hopefully listening and getting something out of it. That was the first decision. Second decision is, do you want to come in and see us? Third decision is, are you comfortable sharing data? That's a big one. Most of us are very private about personal financial information. And then the fourth decision would be, after we get that data, we'll come back with ideas, suggestions, things for your consideration, recommendations, and that's the last decision. Do I want to implement any of these recommendations and engage these folks in a relationship, yes or no? You control the process, you control the speed. No one's going to ask you to do anything you're not comfortable doing. Nobody's going to twist your arm. There's tremendous upside, there's tremendous opportunity, and there's literally no downside. I'm asking you, as much as I like to help people, I can help people the most if they're actually clients of Wealth Enhancement. Look, Wealth Enhancement doesn't exist just to make money. Wealth Enhancement doesn't exist just to be profitable. Just like we don't live to breathe, but if we don't breathe, we don't live. Wealth Enhancement, if we don't make money, we don't exist. And if we don't exist, we can't help anybody. So yes, if you work with us, there's a cost, but we should be able to demonstrate to your satisfaction that you're better off with us. Net of cost, you can see that you're better off because of this relationship than without it. And again, that's what makes my heart happy, is that it's truly a win-win. Our clients are better off with us than without us, and we can demonstrate that to them. We have an opportunity to make a reasonable profit so we can continue to exist and continue to help more people. And when it works right, it's a wonderful, wonderful thing. And we'd love to have you come and see us and give us a chance to show you what we can do for you. And that's probably enough commercial. Tom, I know you want to make sure we have some time for some questions.
Yeah, and we do have a few questions here. And again, I want to be conscientious of everyone's time, so we're probably only going to get to a few of them. But the first one we got here. I just retired and already have a large stream of dividends coming in, as well as a lot of interest income. Add to that a large portfolio of stocks, about half in a non-taxable account and half in a 403(b) account. How do I keep taxes reasonable?
So what a great question, and I kind of talked about that in the presentation, but let me jump into that one more time. So when they say tax advantaged, I'm assuming they've got stocks probably like in a Roth IRA, and then they've got also investments in a tax deferred account. So again, we look at every year and we say, how much income do you want in this particular year? And by the way, it might be different next year than this year than last year. You might have different things planned, a trip, taking the whole family to Disney World, whatever. But we'd look at the beginning of the year, what do we think your income needs are going to be? Then when we think we know how much income you want, we determine what is the smartest money to spend first. Now, again, a lot of that is going to be based on tax consequences. We might want to soak up the tax bracket that you know you're going to be in anyway, even if you don't take this income. They mentioned that they've got dividends and interest from some other investments, so obviously they have taxable money. It sounds like, by the way, the person asking the question has done a good job of creating tax diversification. I applaud that. So how much should come from taxable? How much should come from tax deferred? How much should come from tax advantage? we have to look at it. Then we also look at the investment. So for example, like I alluded to earlier in the presentation, if stocks are very high, which they are right now, they came down a little bit from their all-time high, but if you've been in the market for a long time, you probably still have a lot of embedded gains. And selling stocks right now, you're probably locking in big gains and earnings and winnings. So, but if stocks were down, or we just went through a big market retraction, we might say, let's go spend bonds, let's go spend cash. So every year we look at how much income you want. We determine what's the smartest money to spend, and by smartest, it's a combination of tax considerations and investment considerations. And again, the smartest money this year might not be the smartest money next year. So it's something with our clients we look at least once a year, or in many cases, maybe even twice a year, depending upon if those income desires change during the year or not.
All right. Just again, for time reasons, I think this is probably going to be the last question we got here. How can I lower my RMDs in my IRAs to help save money? I've had them for about 5 years.
Yeah, once you're in RMD, in other words, once you've reached the age where you have to start taking the required minimum distribution, you might be limited. But one of the strategies that we use a lot, and this is particularly effective for somebody that's charitably inclined or philanthropic anyway, you can take a portion or even 100% of your required minimum distribution, and you can give that directly to a charity or charities of your choosing, a 501c3 or church or whatever. And so it's a way of taking money out of the IRA and not having to pay the tax. Now, obviously, you're not able, the money that goes to charity, you're not able to use it or enjoy it for lifestyle. But if you're going to do charitable giving anyway, it's the most effective way to do that charitable giving, and it does reduce the taxes that you're going to pay on that RMD. That's probably the most efficient thing that we can do at that point of your life, and we do that with a lot of clients. We're very blessed, very fortunate that we do have a lot of clients that are philanthropic, and that's their way of doing their charitable giving.
All right. Well, thank you, Bruce. Again, I think that's going to be all the time we have for questions today.
I was too long-winded. I'm sorry, Tom.
No problem. A lot of great information that was covered. So, but again, I want to just remind everybody that anything that we didn't have time to get to, we'll make sure that somebody reaches out to you individually to get that question answered. Again, I want to thank Bruce for joining us today. Like I said, a lot of great information. I appreciate everybody else for joining us. Hopefully you can join future sessions. I believe we'll have one next month. And so be on the lookout for that. And again, just want to remind everybody that this has been recorded. A replay will be sent to your inbox, but also check out our YouTube channel where we will post the recording of this. We also have a lot of other great stuff on our YouTube channel, also on our blog. Thanks again one last time, and everybody have a great rest of your day.